Super Microcomputer Inc. ticker symbol SMCI is currently trading at $18 a share. It is down 11% on the day, and this stock has had a terrible year. From its highs of $120, it is down around about 84%. Now, this stock has had a lot of negative sentiment, potentials delisting from the NASDAQ. The deadline looms. It is the 16th of November, coming very, very soon. And there is accounting scandals. We'll be talking about this a little bit more, but we're going to be looking at my automated stock valuation spreadsheet, looking purely at the fundamentals of the company to see if it is a buy or a sell using the discounted free cash flow model, comparable company model, and of course the Ben Graham formula for intrinsic value. So, just as I said, there has been a lot of negative stuff around super microcomputers. NASDAQ potentially delisting them because they failed to deliver their annual 10K form. They had to do it within 60 days of September the 17th. This puts the deadline on a Saturday, and as of today, they have not publicly stated whether or not they're going to submit this or not. This all happened when the short-selling firm Hindenburg Research alleged serious red flags with the company's accounting. EY as well, the company's accounting firm, has resigned, unwilling to be associated with the company. So things are looking very, very grim indeed. But despite the accounting scandals, we're going to be looking at their financials. So what we'll do is we'll put the ticker in SMCI, and this will load all the latest company financial data, and we're going to go on the assumption that this is correct. But still, a lot of people have been requesting this stock from a fundamental analysis. So $18 a share, 10.5 billion, a PE of 8.98, which is way lower than the market average, which is currently at 30. $2.01 a share, earnings per share. Beta of 1.28, meaning it's more volatile in the market. And analysts currently saying it is a buy with $38.93 a share. They do not pay a dividend. So let's have a look at the revenues. If the numbers are to be believed, all-time highs in revenues, 11.82 billion, beating the last year of 2023, 7.12. They had a bit of slow growth here in 2021 and has shot up dramatically in that time. Are they profitable? Yes. $1 billion in profit. Once again, all-time highs, twice as much almost as 2023. Profit was pretty steady for a number of years and then has exploded in the last 2 to 3 years. Free cash flow is a different story though. Negative. Minus 2 billion. Had all-time highs in 23. You can see free cash flow is all over the place. A little positive, a little negative. Was on the right track in 23, but down now. So we want to look at the operating cash flow versus the capital expenditures, which is free cash flow, see if they're spending a lot in capex, but no, that is not the reason. You can see operating cash flow negatives as well, so that's why the free cash flow is down. Shares outstanding, shares have been consistent, but there has been some splits here, which is why the chart isn't looking too correct here. So let's have a look at the discounted free cash flow model. This is a way of valuing companies, looking at their future free cash flows and discounting them to today's value. Currently gives us minus $9. This is because of the minus trailing 12 months, but let's have a deeper look at the numbers and see if we agree with them. So we are expecting around about 14.2 and 17 billion in the next years in terms of revenue. And analysts are a lot more bullish, 25 and 30 billion. Wow, that is a lot higher. So let's bring that average up. We'll go with 30. Oh, it's even higher than that. 40%, 40, 50. 60. What were the numbers again? I said, sorry, it was 25 billion and 25 and 30. Wow, that is a lot higher. Okay, so analysts are expecting crazy growth. We'll stick with this. Still negative because of the free cash flow. Net income margins, I will leave that at this for now. We'll go with the 24 number of about 10%. That puts it at $10 a share. So realistically, we would need to expect a lot higher growth. Now let's just see if they can kind of match their 9%. Before, $16 a share. So really they need to keep on generating free cash flow, which they have not done consistently for quite some time. But if they were able to sort of match those the previous year numbers, then this could be a buy on the discounted free cash flow side of things. Before we continue, please check out my Patreon, links are in the description, and like and subscribe if you haven't already. And if you have, then thank you very much. So we'll look at the Ben Graham formula for intrinsic value. This is created by the grandfather of value investing, Ben Graham. looks at earnings per share, PE of a non-growth company, AAA bond, corporate bond, and the AAA bond yield currently is 4.95%. What do analysts say in terms of growth for SMCI? Well, they are expecting... I'm doing a bit of a drum roll here because I saw it before. They don't have an estimate for the next 5 years, unfortunately. So this chart doesn't work realistically. But if we were to go with their 30%, it puts the stock at $64 a share. That is if they could continue at the rate they had been over the last year. For the stock to be sort of a fairly valued, this is with a Ben Graham margin of safety, that would be at about, oops-a-daisy, my mistake. It would have to be about 6%, and that would be $24 a share. So Ben Graham's formula really does like the stock. And finally, we will look at the comparable company model. This is a way of valuing companies, looking at similar companies in similar industries, sizes, and we'll be looking at certain metrics here: revenue, 5-year growth rate, EBITDA, net income, profit margins, price to sales, price to book, PEG, EV to revenue, EV to EBITDA, PE, and forward PE. So I was looking at Seeking Alpha and things, and the list of companies initially gave me was Dell, ticker symbol Dell, funnily enough, HP, and IBM. Give a comment down below if you want me to compare it with different companies, SMCI, comparable companies. Then you can we can see. But yeah, it's right. Okay, so here we are. So enterprise value is the smallest by quite a bit. Revenue, smallest again. Positive net growth, revenue. Sorry. Net income's up. High profit margins. Price to sales lower than the market average with about 3. Sorry. Price to book lower than the market average with a average of 5. So that's looking promising. PEG, Peter Lynch's price to earnings growth. You want to be under 1. It's under 1. EV to revenue, lowest. EV to EBITDA, second lowest. PE, lowest PE, lowest forward PE. Buy. $33 a share. So looking good in terms of fundamentals, but as we said, with the news about the delisting and potential accountancy fraud, obviously I don't know them more than what I have read, but it is a very, very risky play. But a lot of people are liking that because obviously it was at this price and is now down here, so people are hoping it can do a similar thing. Right guys, thanks for watching. Please give a like on the video if you enjoyed it. Subscribe if you're not already. Oh, and also just on my Patreon, I've changed things around. I've lowered the help me out thing to $1.50. If you want to help me out, you don't get anything apart from maybe a shout out. You know, I'd be very appreciative. I can buy better mics, buy all that rubbish, green screens, better computers, all that rubbish. I shouldn't call it rubbish. It's not rubbish. It's necessary for the channel. If you want to use the automated sheet, I have lowered the price to $5. Where you can access the sheet that I use, and you get your own account, and you can do all the analysis you want. And finally, the top tier is the sheet plus. You can ask for specific stocks to be reviewed. Now I do review a lot of them anyway, but yeah, you can have specific reviews done by me and things like that. Right guys, thanks for watching, and I'll catch you all next time.